The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. Wealth Builders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 66 of Wealth Talk. My name's Christian Rodwell, the Membership Director for Wealth Builders, and I'm joined today by our founder, Mr. Kevin Whelan. Hi, Kevin.
Morning, Chris. We found a very fast route to 66, don't you think?
Yes, indeed. Indeed. It's whizzing by, but lots of fun. Every week we enjoy this, and hopefully everyone listening enjoys it too. And of course, we thank you for all the reviews and the kind words that we very often receive. And today, Kevin, we've invited back one of our close friends, our good team member, Paul Brooks, and we'll be hearing from Paul very shortly about a special type of insurance, which is for business owners, and certainly a wealth building, an unknown wealth building secret, shall we say, for many people.
Look, there's lots of hidden secrets in the world of wealth, and they're normally to be discovered. And if you remember way back, Chris, crumbs, it might even be episode 1 or 2, I talked about almost having the curiosity of a child with the ROI, which that your one relationship, opportunity or idea, ROI, from a complete transformation in your wealth. So one of the things I love about the podcast that we do, Chris, is we're discovering and sharing nuggets for people to decide whether they want to pick up and polish or whether they want to put them back down again and just ignore them. And that's fine. And that's certainly one of these is it's a nugget that needs to be polished, but you kind of need to understand it, because I think the way you introduced it, Chris, sounds a bit boring, right? Insurance? I mean, who wants insurance?
Yeah, I know. And I guess life cover, it splits opinion, Kevin, and it'd be good, to understand really who needs it. Is it something everyone should be thinking about, or are there different times in your life maybe when it's more important than others?
That's a really great question. If you think about it, insurance is a way of putting things to the way you would want them to be, right? Your house burns down, the insurance puts it back to where it was before. If your car gets wrecked, you get a new car, you get the car essentially repaired. And this is true much more so when you're talking about people, not so much that you can replace people. Of course, you cannot do that. But if you think about from a wealth perspective, Chris, what people do is they're almost like an asset in themselves and their capacity to generate income. Now, for most people, that's trading time for money. So therefore, it's quite critical whether you've got a job or whether you're in business. So it doesn't matter whether it's this special kind of life cover or not. You've asked me the question specifically about life cover. And I think life cover is a wealth replacer. It kind of says this: I would like to be wealthy. I would like my family to be wealthy. I would like to leave a great legacy. These are the things that I want to do, whether I'm alive or whether I'm dead. And of course, we know unfortunate things happen. We know that happened with my dad, which was the very essence of how I got started on my own wealth building journey as powerfully as it incentivized me to do so. So, that's an important thing. And my dad didn't have any life cover, so he didn't imagine the consequences to the people left behind, because he got seduced by the thought that I'm earning loads of money that will continue forever. And of course, with life, it doesn't continue forever. We always know that quote, don't we? Death and taxes. So in my view then, and certainly the wealth builder view of life cover, is you, generally speaking, need it for two purposes. One, for the elimination of debt, particularly if you don't want your family to, in a home, for example, a mortgage, you don't want them to be in a position where their home could be at risk. Now, putting that to one side, the second reason is that you are on a journey, hopefully, to be building your wealth. and you're going to put assets in place to generate that wealth. And we know that our typical client, Chris, wants a target, and it's not mean everybody's target's the same, but the average we get for independence about 10,000 a month, right?
Mm-hmm.
So if we say, all right, let's make it very simple. Say somebody says, I would want to build, if I'm alive and well, to enjoy and share 100 grand a year. And the question then is, well, do you want that same 100 grand a year to be provided if you don't make it? If your plans get interrupted by something that devastates you? And that's what insurance does. So if you think about it, then it's a wealth gap plan. It's the insurance that provides the asset if you don't live to provide the assets yourself. Stated differently, if you have a sum of money and you know what the predictable ROI is, return on investment, then you know how much life cover you need. So if you need 100,000 a year and you can get 10% on your money, or you believe your family can, then you'd need £1 million worth of life cover to do that, right? If the gap was 0 to 10, you had no recurring income at all, no wealth at all, then if you believed it was 10%, 10% times 1 million would give 100,000 a year, and that would give them 100,000 a year forever. However, most people don't know how to get 10% on their money, particularly at the beginning of their wealth building life. So therefore, you might say, well, predictably, if they put the money in the stock market, in low-cost trackers and those sorts of things, they might get 4 or 5%. Okay, then that would be 2 million. You see the point? So the whole essence of life cover is to work out the gap between what your current wealth income is, what your recurring income is from assets, what you want it to be. Now, it could be security you could aim for instead of independence, but either way, you choose the figure that you're looking to aim for. You calculate the predictable ROI, and in doubt, choose 5% for now, just for a number, and that tells you how much cover that you need. And when you get to a place where you live then, and you build your wealth, and we know it can take typically 3 to 7 years, so let's say it takes you 5 years, then if you've got all the wealth you need, you've produced all the assets, you've got all the income you need in 5 years, so you can provide a predictable income flow to you when you're alive and your family if you're dead, do you need the cover anymore? Answer, you do not. So the whole idea of life cover is a temporary gap, not a long-term thing. You buy, like investing in the stock market, you buy it and you forget about it. You may want to keep it, certainly, but you do not need it. So that's the point. So if you can get £1 million or 2 million quid with a cover that lasts for 5 years or 7 years or however long it's going to take you, that's probably all you need to do, and your family will be certain of their wealth, whether you're alive or dead. Does that help?
It does, yeah. And probably highlights for a lot of people that they're probably paying unnecessarily or overpaying on their insurance and not necessarily thinking about how it fits into their overall wealth plan. So I think that is very interesting. Yeah.
Yeah, I think people are, I think two things, Chris. People are overpaying for sure, as you'll hear from Paul. I mean, there are huge tax savings on average, if you listen to what Paul has to say and get through any podcast which talks about insurance, you realize you'll probably be able to halve the cost of the cover. Now, think about that. If I offer, so let's say you choose, Chris, a level of cover that you want. If I said to you, I can offer it to you at this price or 50% off, you take the 50% off every time, wouldn't you? If it's the same cover, no difference in the cover, actually better cover, as you'll discover when you listen to Paul, then it's just amazing that so few people discover this. And partly because they buy life cover either online, so they think it's cheap, but it's never 50% cheaper, or two, they don't trust anybody. They think this is the best way to do it. It's a kind of a DIY solution instead of talking to somebody who knows what they're doing. And of course, 3, you need to discover it. So I hope that this message gets through to some of our audience and they pay attention and make a note in their 30-day cycle of doing something good in their wealth is to take a 30-day period, whether it's July or August, and look into, or have us help you look into, the concept of relevant life. Well, I think we set it up well for Paul, haven't we?
I think we have. And of course, Paul was only with us a few episodes ago, episode 63. And Paul is the SaaS director for WealthBuilders. And he was talking then about how you can take control of your pension. And of course, the best way of doing that is through a SaaS. And again, that's for business owners. And once again, Paul returns today to talk to business owners. So he really is a business owner's best friend, isn't he?
Yeah, he is. And, all in truth, whether you're a business owner now or not, if you want to be wealthy, you're going to need to be. Maybe, Chris, I'll touch on some of the other benefits that business owners uniquely have in the roundup with Paul, so that we get the chance to listen to what Paul has to say on this specific subject. But yes, it's uniquely available to directors of limited companies and not to sort of, employed people in normal 9-to-5 jobs.
Okay, let's head over now to our conversation with Paul Brooks. Paul, welcome back to Wealth Talk.
Hi, Chris. Glad to be here.
I know it took 63 episodes to get you on, and now we're back within just a couple of episodes later. So
I can't get enough.
Well, today we're focusing on something different, and we're focusing on a type of life insurance which has definitely got some benefits for business owners and wealth builders. So why don't we dive into what exactly is relevant life insurance? Sure.
Well, it's really a fantastic tool for business owners, uniquely for business owners. And though the name sounds a bit obscure, relevant life, the way I would describe what it does is really a director's or a key employee's death in service life insurance benefit, but it's specifically tailored for small businesses. And ultimately what you're doing is creating individual life insurance policies, but in a super tax efficient way, which on 6 different levels, and we'll cover that, I'm sure, in a moment, saves tax. So effectively you're getting a tax man to pay some of your life insurance premiums, which is pretty cool, I think.
Yeah. Well, I guess let's look at those 6 different ways then, and see just how beneficial this can be.
Sure, absolutely. So relevant life or director's life insurance, whatever you want to call it, is very, very similar. In fact, it's pretty much identical to a normal personal life insurance. It isn't a super complex, super fancy type of cover. It's really just the treatment of the cost of the premiums that make it unique, and the way that it's set up is slightly different. So in simple terms, really, a relevant life policy is a policy that your business, your limited company, would take out, and the limited company would be the owner of the policy. Okay, so the policy is created by the business, and it's set up against a person which would be called the life assured, and they are the person on whose basis a payout would be made if they passed away. So the business owns the policy, and because it owns the policy, it pays the premiums. And the person who's covered is the life assured. They are the person whose family would be benefiting from the proceeds of the insurance if they were to die. Okay, and that would typically be you, the director of the business, or another key employee, perhaps part of your executive team if you have a slightly bigger business and you're looking to provide benefits to your employees. And the biggest benefit, and the first of the 6 tax savings where relevant life is concerned, is that because the policy is owned by the business, it's a genuine tax deductible corporation tax expense. So your first tax saving in the 6 tax savings that I mentioned a minute ago is that corporation tax. Mm-hmm. So today, as we're speaking right now, 19% saving on your corporation tax, because the cost of those premiums are tax deductible, which is pretty amazing. So even on a like-for-like basis, and you've got that immediate cost saving compared to having a personal life insurance policy.
Pretty cool.
Yeah, pretty cool. That's just one. So the next one is really a tax saving that's relevant to the director or the employee who's had the life insurance policy taken out on their behalf. Remember, the company is the owner of the policy, the owner of the premiums. But when you have benefits paid for by your company or by another business that you work for, very often they will attract something called a benefit in kind tax, which is basically HMRC's way of collecting tax on something that isn't paid to you as money, but is paid to you in some other form. And very commonly that would be, a company car, but it's also life insurance. And sometimes you would have a life insurance policy created by your employer, or sometimes if you're a business owner and you want to try and run your own insurance premiums, your own personal insurance premiums through your business, if you did that, they would attract a benefit in kind tax. And that means you'd basically be paying income tax and national insurance on the value of the premiums. Well, Relevant Life is exempt from benefit in kind tax. So you, the person who's getting the benefit of the life insurance policy paid for by the business, don't then have to pay that benefit in kind tax. So there's super tax saving number 2.
Right. As if any tax was kind, hey?
Well, exactly. Yeah, that's brilliant. I like that. Yeah, absolutely. So, the benefit to the person with the premiums is they're not suffering that benefit in kind tax. But that then takes me on to tax number 3, or tax saving number 3, I should say, which is employers' national insurance. So in the same way as the person who's getting the benefit from the business would typically be taxed, the employer who is providing that benefit must also pay national insurance from the employment perspective. So in the same way as a salary that is paid from a business, depending on how much is paid, attracts employers' national insurance, which is roughly about 14%. That would also occur if you had benefit in kind payments. But again, because Relevant Life sits in that really unique, specific part of the tax rules, it's exempt from employers' national insurance too. So there's another huge tax saving there.
Going well so far.
Yeah. So those 3 are, I guess, immediate tax savings in your life today. The next 3 are more about tax savings either for your loved ones in the future or for you later on in life. Okay. Number 4 is inheritance tax. So, on some level or another, most people are wanting to pass on a legacy down to their family. Of course, they want to do it in a tax efficient way. Nobody wants to pay more tax than they need to. And it's very easy to not quite get everything wrapped up in a neat tax efficient bundle and ultimately trigger some kind of inheritance tax liability somewhere down the line. Well, with Relevant Life cover, your policy is written into a trust from the day it's created. And is it worth just having a very quick segue on trust, just to kind of,
we can definitely point back as well to some previous episodes, but for those, perhaps they're still not quite sure exactly how trust works, that'd be useful.
Okay, so quick 30-second overview then. A trust is basically a legal document which ring fences and protects assets or cash. And it's used for a number of reasons. Trusts have been around for hundreds and hundreds of years in England and in the UK, but predominantly they're used to protect assets and protect cash for future generations. And one of the single biggest benefits of a trust is that it ring fences, it pushes outside of your estate the asset or the cash that you've placed into it, which means that it isn't accessible for inheritance tax. Now, life insurance, with barely any exceptions that I can think of, should be written into trust, because it immediately then protects that benefit for your loved ones for forevermore. Relevant Life is automatically written into trust when the policy is created, meaning there's no danger of that money accidentally creeping outside of the trust and going into an estate and therefore potentially becoming taxable somewhere down the line. it's wrapped up in that neat tax-free bundle from day one. Okay, so you're automatically protecting not necessarily a spouse or a partner, but possibly children further on down the line from a big inheritance tax bill.
Right.
Tax saving number 5 is still broadly the same point, but it's thinking about the way that you can then use that trust with the money that's been paid out from the life insurance. Unfortunately, we've had to kill you off for this example, Chris, right? But if that's okay, we'll imagine we've created a policy for you. Something tragic has happened. The life insurance has paid out. The trust has collected that benefit. It's done the job it was designed to do, which immediately keeps it out of the estate. Now, if that trust is then managed properly for the people who've ultimately inherited it, your next of kin, they can access the money from that and use it for whatever they want, paying off debt, buying assets that produce income, which of course very much sits with, huge theme of wealth builders, of course. And frankly, they can use it for anything they want. But if a trust is used properly, it has I guess what you'd call a rollover effect for future generations, because you can actually use that money and that trust to reduce inheritance tax even further down the line for other people. So let me explain what I mean by that. If you can imagine the money's in the trust and your partner wants to take some money to pay off the mortgage. Well, that would be logical. That's one of the main purposes that people want family protection and life insurance. But let's imagine that instead of just taking the money and it being discharged to your partner, instead, what she does is she borrows the money from that trust. Okay, and there's a proper agreement drawn up between the trust and between her that says, the money will be loaned. It will be loaned for her entire life. It will not attract the requirement for a repayment until the day she dies. But an interest will be charged each year for the duration of the time that she has that money.
And who decides on that? Is that the trustee?
Yeah, it would be the trustees, and typically that would be your partner and possibly some other people. And you, as the person creating the policy, would get to choose who you'd want your trustees to be from day one. So, again, a separate topic, but it's important to choose trustees that will have, your loved one's best interest at heart. And of course, they themselves can be a trustee too. So let's imagine, going back to that example then, that your partner's got the money and she agrees this repayment-free but interest accruing loan. And let's just imagine, for the sake of an argument, it's 5%. It doesn't matter, but let's just imagine it is. So the loan is made, your partner uses that money, she pays off the mortgage, she does some other things, the money gets spent and distributed, and then hopefully many years down the line, something happens and she passes away. Now, what actually then happens is that money is a debt that is owed back to the trust. And if you remember, that 5% interest has been accruing and accruing and accruing year on year on year on year. So not only does her estate, which, remember, in many cases is tax assessable for inheritance tax, her estate not only owes the original money that she borrowed, but it also owns the 5% of compound interest year on year on year on year. So if you think about what that's doing, it's actually reducing the value of her taxable estate, because it's taking a chunk of value out of her estate that is rightly legally owed back to the trust. The trust itself doesn't have to worry about taking the interest during her life, because it's got that agreement in place, but it wants it on the day she dies. So a big chunk of money goes back to the trust. What that's actually done is dramatically reduce the value of your partner's estate, and therefore the chance of her paying inheritance, her family, her loved ones paying inheritance tax on that money is, either reduced or perhaps even eliminated altogether.
I get it.
Which is super powerful.
It is. And I'm sure people are thinking now about different scenarios, and we'll have a lot of questions about that.
Yeah.
But I'll let you finish.
Yeah. Okay. All right. So those 4 and 5 are all about inheritance tax. Okay. So tax saving number 6 now. And this one is particularly valuable and important for people who have bigger pensions in their life, because a lot of death in service policies that are created through traditional employment are done in such a way that means that they are assessed on the day of your death along with the value of your pensions. And there's something called the lifetime allowance, which is really, I guess, a glass ceiling, but nonetheless a limit on the amount of money that people can have in their pensions, and before they start to have some tax paid on some of it. Lifetime allowance is super complex. Very happy if, we could have a whole podcast on lifetime allowance easily. So without, losing track, I guess it's really, at the moment, it's about £1 million, £1,070,000-ish, something like that. And over and above that amount, there is sometimes a tax to pay on the difference. Well, if you've got a big death in service policy with your employer, then that value of the death cover that pays out on your passing away is added to the value of your pensions. And if that pushes them over this threshold of £1 million and some pounds, you're then getting taxed on that. So even though you've done a great thing by having life insurance set up to protect your loved ones, the tax man takes a big chunk of it, and we know how hefty the tax on death, on inheritance is, 40%. So an enormous chunk of that money that you've set up and thought will be there and available for your family could be swallowed up.
Every opportunity, hey? They take.
Mm-hmm. Yeah. And, there's people sometimes call the lifetime allowance a stealth death tax. And actually, in truth, it is. But back to relevant life, because of its uniqueness, because of the way it's set up, does not fall into the lifetime allowance. So if you have big pensions, or you're coming close to the lifetime allowance, and definitely if you're in excess of the lifetime allowance, and you've got a death in service policy through your employer, relevant life could be a way of mitigating that potential lifetime allowance tax in the future.
Wow. Okay. The compounding effect there is pretty impressive. And why is this not so well known, Paul, necessarily?
Well, that's a great question. And I suppose, like all good wealth building tools, it needs people to shout from the rooftops about it, because it isn't mainstream. And I guess the reason it isn't mainstream is because it isn't available to everybody. It's only available to genuine business owners. And there does have to be a proper employee-employer relationship. So unfortunately, sole traders can't have relevant life. Partners in a partnership can't have relevant life. It's really mainly for limited company directors and LLPs, where there's a formal company set up and then there are employees. Even if those employees are the directors, that doesn't matter. Mm-hmm. Mostly it is directors taking relevant life cover.
Okay. And what about the cost? How does that compare to a regular life cover?
Well, that's a great question, and you might be surprised to hear that it's exactly the same.
Wow.
So if you lined up £100,000 worth of bog standard personal life insurance with £100,000 worth of relevant life, the gross cost before any tax reliefs is exactly the same.
So my next question, where do we get this from, Paul?
Well, unfortunately, it's not something you can take off the shelf. And in a way, actually, that isn't necessarily such a bad thing. So with standard life insurance, you can go to a financial advisor, or you can go directly to an insurance company. And we all know the big names, the household names that probably provide household cover, car insurance. They also all provide life insurance. Relevant life is a bit more niche. All the reasons we've just talked about make it a bit more niche. And because of that, it's not something you can get directly. You do need to seek that professional advice and guidance from a qualified financial advisor to make sure that you're setting it up, because there are a couple of rules. There are some limits to how much you can take, which kind of links back to salary or drawings. But it does need to be set up and created by a financial advisor. It isn't something you can go directly for. That's the only downside of Relevant Life. And I guess that isn't really a downside. It's just a stipulation.
Sure. And if, of course, anyone wants to find out more, then Wealth Builders can help, and they can get in touch with us. Yeah.
Absolutely.
Okay,
Yeah.
Great. Well, look, that has been so helpful, Paul. I'm pretty sure many of our business owner listeners will be, really strongly considering this as an option now. And why wouldn't you?
Well, absolutely. They definitely should be, and even if they're not pushing their own personal insurance premiums through their business, which can be done, but really isn't a very tax efficient way to do it at all. Even if they're just paying life insurance premiums themselves personally, 3 or 4 of those 6 tax benefits still apply. So you're still making the corporation tax saving. You're still making the inheritance tax saving, not just for your immediate family, but for multiple generations down the line. And of course, the lifetime allowance point is still relevant too.
That's brilliant. Well, Paul, you dropped the bombs on the last episode with the pension control. You've done the same again today, so we better start planning your return pretty quickly.
Well, honestly, I love these sessions, Chris, so I'd be delighted to come back. Really happy to do that. Thanks for having me.
Thanks, Paul.
Cheers, Chris. Bye-bye.
Okay. 6 tax-saving benefits there, Kevin, making the subject of insurance almost mildly interesting.
Yes. I think it's not the subject of insurance that's interesting, to be honest. It's the subject of business. Because if you're in business, you're in a unique position that the tax environment in the UK is skewed towards helping business owners more so. And that's probably true in most Western society, actually. I think business owners have got the power to do things that helps themselves, their business, and their families in a way that employeeship just doesn't allow. Paul talked previously about SSAS. That's only available for directors. Relevant Life. Well, when you think about it, it's most of these things, they're just awkward terms. They wouldn't win any prizes for marketing, would they? Relevant Life? Why Relevant Life? It doesn't seem to make any sense at all. It should be Director's Life Cover or something. The same as SSAS, Small Self-Administered Scheme. I mean, come on, who invented that term? Terrible marketing terms. Anyway, when you see through the terminology, and that's, I guess, part of the problem, you get to see some real benefits. So why is this relevant to you? Haha, no pun. It's because if you can see and be committed to being a wealth builder, building wealth for you and your family, then you should have a business, because having a business will open these opportunities to you. Not just the SSAS, not just Relevant Life, but things like unique tax benefits like entrepreneurs relief. So instead of paying a fortune when you sell your business, you only pay 10% tax. Different ways that you can create benefits that you can enjoy in your life today that employees would have to pay tax on, and you as a director do not. In fact, Chris, I've written a whole new kind of, it's not quite an ebook yet, but it's headed that way. It's kind of on the stocks, but not quite finished. I mentioned it to you, Chris. It's my best kept secret for directors and how they can draw, emphasize the word draw, money from their business in the most tax efficient way to serve them, their wealth, and their family. And draw, you know me, Chris, I love a good acronym. Draw, D stands for Director's Pension, that's your SSAS. R stands for Relevant Life, which is what we heard from Paul today. And looking at the corporation tax benefits, NI benefits, inheritance tax benefits, and all those kind of things, really, in the end, just much more powerful. And it's in trust, which is all life cover needs to be in trust, really. A stands for building assets, which is a wealth builder principle, of course. But, these things can, particularly SSAS, can facilitate the ownership of building recurring income assets inside your company and recurring income assets outside of your company. And on that subject, Chris, I think soon we'll be hearing from the brilliant Daniel Priestley, won't we, about assets and how you can build them in your business. I'm sure he's on your stocks, definitely your trying to get him to a podcast near us sometime soon, aren't you?
Coming real soon.
Oh, okay.
Indeed.
Look out for that one. He's a top guy. So A for assets, and then W for well-being. I mean, directors, fortunately, kind of can control their package and kind of link their overall personal benefit to the business. And so you can claim and draw things from your money, from your business rather, for your well-being. And that means your well-being personally, like you can pay for health checks, you can pay for pension reviews with IFAs, all tax deductible, and of course, no benefit in kind tax, so that it's not imputed as a value. That would normally be the case if you were getting this provided by, typical employer. And the other one, of course, which is quite important, Chris, and certainly appropriate now, given the environment of cars as we're moving increasingly towards EVs or electric vehicles, is the concept of actually being able to have an electric vehicle paid for and provided by your company with virtually no personal tax whatsoever. And that's really unheard of. So the electric vehicle benefit in kind tax is zero in the current year. Means, you can have your company provide you with a very nice vehicle, whatever tickles your fancy, and the company can pay the cost for that, and it costs you absolutely zero. So, as you know, my electric vehicle is on its way to me soon. So, looking forward to enjoying that, and the company paying for the cost of that, and it costing me virtually nothing. A little bit next year, about 1% next year, but tiny, 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 tiny compared to if I was an employee. Most of these things you do as employed people, you just don't get that same benefit. So anyway, hopefully that will be useful. Maybe I can cover that on another day, Chris.
Yeah, we can probably dig into more detail, and I reckon we could put together a freebie as well to help our listeners with that as well.
Oh yeah, I can definitely create a guide to draw the DRAW, and maybe I can do that within the next few podcasts, Chris, something like that.
Okay.
It wouldn't take me too long.
Good. Yeah, sounds good. Now, Kevin, at the beginning, you talked about the relevant life insurance actually in some cases being cheaper. Mm-hmm. So the wealth building lesson we always talk about is if you're making a saving, and especially we talk about this within our debits process, and on average, members in our 7 Steps to Wealth program, when they go through this, are finding around about £800 a year as an average saving. That could be anything up to about 3,000. But it's important that you then reinvest that money back into wealth building pillars, so that it doesn't just fall through the cracks and disappear, because it's very easy for that to happen.
Yeah, and relevant life is an important part of that process, actually, because, as I said, if you can save 50% of the cost and pass the cost on to your business, then it costs you nothing from your personal income at all. So consequently, that frees up not just the saving, because the company's paying for it, and the company's tax deductible, so there's a huge benefit there. So I think Paul summarized very ably, actually, all of the different benefits, and I think it's hard to argue with any of those. The only thing I think is kind of just be mindful of, and I've spoken to some of our members about this when they get excited about it, and understandably so. If you've had any kind of a health scare, or you've had whatever personal insurance for decades, then obviously insurance is underwritten. Some insurance company, because it's the same insurance really, so the same insurance company is going to underwrite you from a risk perspective. So if you took out insurance when you were 25 and you're now 50, probably it's not going to make as much sense because, you're so much older. Or if you've had a health scare, then you may not get insurance. So it's just be mindful that this is a potential benefit, and please never, ever cancel anything that you've got until you've had a conversation, as Paul mentioned, with a professional. And anybody who's interested in this, Chris, if they drop an email to hello@wealthbuilders.co.uk and just say relevant life, then one of our experts will be more than happy to try and help you understand the pros, the cons for a balance, and also to do a free check on, what the cost might be compared to any costs you're paying. So, we're always keen to help, but we don't want anybody to rush headlong, get excited about what we're saying, cancel what they've got and find they made a mistake. We don't want that to happen for anybody.
Yeah, and obviously the topic of insurance really falls, I guess, within the roof, doesn't it? Which is part of our end-to-end process for helping our members build and protect their wealth. And protection of your assets is covered in episode 8. We talk about the roof. Mm-hmm. And then in episode 23, we talk about trusts as well, for anyone who perhaps is still a little bit unsure of the role of how a trust works, which actually Paul did sum up pretty well in today's episode.
Yeah, indeed. And look, all life cover should really be in trust because, the simple point, I'm not sure if he mentioned it specifically. I think he was talking mostly about the benefit in terms of the accessibility for the beneficiaries. But, if you think about it from a different perspective, one of the things we know about people is, they put off the boring stuff, right? So they put off the pension bit, they put off the life cover bit, they'll put off the roof bit, won't they? We know this is true. And if, for example, you've got life cover, but you don't have a will, then if you don't have the life policy in trust, which is just a simple document, it's nothing, it's a tick box really, nothing more than a single pager that you sign and have witnessed. If you do not have the in trust and you don't have a will, see, you've now got a problem, you've left your family. And the problem is this: without the trust, which says go immediately, go directly, do not pass go, do not go through the will, go straight to beneficiary. That's what the trust does. In the absence of a trust, the insurance company needs a death certificate and they need grant of probate. If you don't have a will, you're not going to get probate. If you've got complicated financial situation, multiple properties, multiple businesses, even if you've got a will, probate can take years, which means while the probate is being sorted, or if you don't have a will, you're in a mess, your family members will not get a check from the insurance company to take care of financial turmoil at a time, the worst time, when they're going through emotional turmoil. So I would say, for the sake of understanding and for a one-page document that costs you £0 in pounds, no pounds, costs nothing to put a life policy in trust. You just have to have someone to do it for you. You have to ask the insurance company for the trust document. You write down the name of your beneficiaries. You tick you want it in trust and you get it witnessed. Job done. This is so simple, but so overlooked, like so many good things in wealth, Chris. People get caught up with what sounds sexy, what sounds interesting, and they don't take care of things that in the end, if they were looking back, they would wish they had taken care of, as I'm sure my old man would have liked to have done the right thing. He had good intentions, bad execution. Please don't fall into that trap if you're listening to this. Take a minute, go and check your life cover, go and check whether your will's in place. And if they're not, give us a call and we will help you. There's no point leaving the roof to chance. A leaky roof is not a good thing.
Yeah, important lessons to end on there. And I will link to both of those episodes in the show notes. So episode 8, which we cover the roof, and then episode 23, where we talk about trusts in more detail there. So thank you, Kevin.
Yeah, I got on my soapbox a bit there, Chris. I get quite emotional about these things just because I see the consequences. We're dealing with people all the time, and we see the consequences of people getting ill, people dying, and so on. And we know the pain that these things cause, and it's not too difficult to at least, put your house in order, so to speak. And I'll keep banging on that drum, I suppose, now forever until people take action. If one person listening to this takes action today, then, let us know, actually. Let us know that we inspired you to take action and you did it. Put it in the Facebook group or drop us an email. We'd love to hear from you because our role is to change people, not just to get on soapboxes.
Thank you, Kevin. Thank you, everyone, for listening today. And we'll catch up on the next episode of Wealth Talk.
Okay, Chris. Until then, see ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the Wealth Builders membership site to help you create, build and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.